What's up everyone, it's Kadi with Money Investing. In this video, we are going to be talking about the consumer's savings rate, and there was a research study done by Alliance and Refinitiv where they published a paper back in February of 23, which is quite alarming because it suggests that consumers will run out of excess savings before the end of this year. And that's most likely going to affect their usage of credit cards, which is most likely going to affect consumer spending, which will affect earnings. So that's what we're gonna discuss in this video. Hope you guys enjoy it. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the buy and sell alerts, options alerts, trading ideas, and of course a lot of other private videos and tutorials and lectures. There is a 16% annual discount that does expire at the end of this month, so link's going to be down below if you're interested in joining us. So this is the actual report. Falling Off a Savings Cliff is the title. Again, was released back in February. I will link it down below if you're interested in reading it. It is definitely a pretty long report, but I'm going to go over some key takeaways. The first thing is, in focus, Americans do fall off of the pandemic savings cliff after the summer break, while Europeans hoard even more. So the U.S. stock of excess savings, in other words, the excess savings in the U.S. has been depleting fast with the reopening and inflation surge. Because of the reopening, people spending more, and not only that, we have the prices at 40-year highs. That's resulted in the excess savings during the pandemic. I showed you guys the savings rate, which spiked to over 33%, and it actually came down to its lowest level at under 3% back in October of last year. And this paper suggests that these savings could be fully depleted after the summer this year in 2023. So this is the different countries with the excess savings as a percentage of annual consumption, and the US sits the lowest at around 8%. So again, if you come back over here, you'll notice that US and Germany, they stand at less than 8%. That is, households' pandemic savings are still large in both Europe and the US. Those excess savings relative to consumption are largest in the UK and Spain at around 20-25%, and the US and Germany at under 10%. Now, this paper also does suggest that in the US, excess savings have started to dwindle as household consumption surges above its pre-pandemic trend. In the US, the rise in excess savings slowed down markedly from the end of 2021. That is a really, really important date to remember. I'll come back to this date, but at the end of 2021, it was just Q4, right? Fourth quarter of 2021 through 2022, while the boost in excess savings in the US stemmed primarily from a huge fiscal transfer bowing up household income in European countries, it was down essentially to subdued consumption. And which they also mentioned, while the US economy now slipping into a recession, which we expect to last through third quarter 2023, household disposable income will come under increasing strains despite falling inflation. As a result, we expect the stock of excess savings to be fully depleted by the end of this year, kind of like very similar to what they also suggested at the beginning of this paper. And these are some of the actual charts that pretty much show us the flow of excess savings in the US, left panel in USD billion, and France is on the right. And what you'll notice is that the consumption is a lot more than the actual compensation of employees, which is income, and transfers, which is fiscal stimulus, right? So both of these things, if you put them together and compare it to actual consumption, if consumption's higher, right, then you have your flow of excess savings going up versus going down. So for example, over here, when you have transfers, which is the actual fiscal stimulus, and income, which was negative because unemployment spiked during the pandemic, excess savings were still high. They were in fact very, very high around that time, 2019, 2020, because there were fewer people employed because of the pandemic, but the government stepped in and provided a lot of fiscal stimulus. So that's the transfers, and consumption was still relatively decent. And as a result, that red line you see, that's the flow of excess savings. That's the actual savings that people are holding on to. And then, of course, starting 2021, 2022, that line pretty much went down in negative now, because now we have negative savings. In other words, more consumption happening with respect to actual income that is being generated. And as a result, you'll notice over here that flow of excess savings and stock of excess savings is now turning to negative territory, where the consumers are now starting to deplete their savings from their bank accounts, right? Which obviously is because of higher inflation and higher spending to begin with. Now, what is the consumer going to do, right? If it's running out of savings, where is the money going to come from, right? What are they going to tap into? Of course, credit card, right? People still need to get by. People still need to, of course, get gas, get groceries, get utilities, all those things. So here are some 2023 credit card debt statistics, which are actually quite alarming, quite concerning in my opinion, because some of the things that I read in this report were actually quite disappointing, not to mention just straight up dangerous financially for people. So Americans have an absolute mountain of credit card debt, $986 billion to be exact, so almost $1 trillion. And remember, I talked about that date, right? We're going to come back to that. But if you take a look at how much the credit card balances have risen, so since fourth quarter 2021, right? Credit card balances have risen by $130 billion. $130 billion. That's in under 2 years. If you come back to the report that I mentioned earlier, that date, which I mentioned for us to remember, which was going to be over here somewhere. I forgot where it was. Right here. So the rise in excess savings slowed down markedly from the end of 2021 and through 2022, right? So savings pretty much went down substantially at the end of 2021. And what really went up, or what actually started going up, it's credit card debt, right? By $130 billion. And the problem with credit card debt is that the interest rate on this debt alone is quite substantial, right? So if you take a look at the average credit card balance on an unpaid balance as of December 2022 was over $7,000. That is what's really concerning. Like, who is not paying their credit card? And $7,000 balance is, and I get it. Look, life gets in the way. There's different circumstances for different people. I'm not here to judge, but $7,000 is, it's actually a quite substantial balance, especially considering when you have interest rates that are at over 20%. I mean, if you take a look at average APR for a new credit card, that's over 23.6%. Then you have average APR for all current credit card accounts over 19%, and the accruing interest at over 20%. So nonetheless, interest rates on credit cards are very, very high. So if you simply just do the math, 20% on $1 trillion credit card balances, that's over $200 billion in interest alone. And I did another video going over the banks, right? We talked about the banks in one of my previous videos, and they raked in over $187 billion in interest and fees last year. $187 billion. The year before that, they were just shy of $200 billion. So the bottom line is that, banks are raking in on interest and on fees so much with the higher interest rates that the credit cards actually carry. So on one hand, you've got depleting savings. On the other hand, you've got higher credit card balances with extraordinary levels of interest rates. And you've also got delinquency rates that are actually on the rise. So this is percentage of total outstanding credit card balances, at least 30 days overdue, if not more. This is at least 30 days overdue. And take a look at what's happened since fourth quarter of 2021. Remember that date I mentioned? Savings rate went down. Interest rate usage went up, so credit card balances went up by 130 billion or something. And delinquency rates, in other words, credit card delinquencies aren't really delinquencies. Nobody's, coming to, of course they can garnish your wages, but at the end of the day, they're going to obviously keep accruing that interest, that higher interest on your balance. So they're not taking away anything. You know what I mean? Like they can come for your wages, but that's about it. With an auto loan, with a mortgage loan, of course, the bank can seize your card, they can seize your house. But with a credit card, it's a little bit different, right? So you're not really delinquent, but of course, everything that's over 30 days or overdue, you're not paying your balance fully. It goes into over 30 days overdue. So that is on the rise. And if you take a look at, how, in the past, like what's happened right before the Great Recession, the Great Financial Crisis, of course, we saw a lot of unemployment back then. And as a result, people were not able to make their ends meet. And of course, we saw a lot of balances that were 30 days past due, 6.5%, closer to 7%. And that started ticking up before it exploded to the upside. Of course, we're still a lot lower. We're still closer to 2%, I think a little bit over 2%. But just think about that for a second, right? How all of this plays out. Incomes are not growing as fast as prices, right? If you think about it logically, savings are not, growing as fast as prices are going up. So on one hand, you've got incomes that are growing, but not at the same rate as inflation, or prices for regular goods and services, regular items that you buy at the grocery store, gas prices, oil prices, whatever. And you've got savings that are depleting at a very rapid rate. You've got interest rates on credit cards that are rising and credit card usage that's going up. Eventually, according to that report that also is suggested that the savings are going to be fully depleted by the end of this year, right? Excess savings will be fully depleted by the end of this year. Now, what ends up happening in that time, right? What ends up happening if people have no money to spend, right? Earnings drop, right? Earnings actually start to pull back, and those are some of the early signs of a potential recession in the US. And something that I have also mentioned again, I think at the end of this year, early next year, there's going to be some serious indicators and serious cracks in the economy that are going to be suggesting for a potential recession in the US. And when that happens, obviously, we're going to see a bit of a decline in earnings. And this right here is a chart that I wanted to go over, which is quite interesting. And what this chart really shows you is a combination of both earnings and S&P 500. So what you'll notice is the market has actually never bottomed before the earnings have bottomed. This is from back in 2000. You'll notice that the market was still at 1100. The earnings bottomed out at $24.70. And as they started pushing higher, the market still had a little bit more room to the downside. It still had more room to go to come down all the way to 800 points. Same thing happened over here. I mean, S&P 500 was at around, 1200 when earnings were at around $14, $15. We didn't quite bottom until the S&P came down to 700, 735. And that's when the earnings were also at their lowest level. And as they started recovering, that's when the markets also started recovering back higher. But the point is, and again, over here as well, you can see it very clearly that, earnings back in 2019, they dropped quite a bit. And when they bottomed out, that's when the S&P 500 also anticipated, right? Forward-looking markets anticipated the earnings are going to be good. And of course, the Fed stepped in with a lot of QE to support the market. And then as a result, we started to push back higher. And what you're seeing right now is a very similar trend. If I zoom in right now, you're seeing the earnings slowly and steadily. They're being cut down, but they're not being cut down fast enough. I mean, we are still seeing earnings estimates that are still pegged at pretty good numbers. For 2023, we're pegged at a little bit over $221 according to analyst estimates. Even though they were expecting a negative 7.4% decline in first quarter, negative 5.8% decline in the second quarter. We're just coming off of a decline in the fourth quarter ourselves. So it is expected for us to enter into an earnings recession pretty soon. But if these numbers accelerate to the downside, meaning that we see bigger downside move in earnings because of lower consumer spending, because of all the reasons that I just laid out, then it's possible that this earnings revision on the downside is still a long way to go. And if that is the case, then the market, right now it's just been trading sideways. I mean, we haven't really gone anywhere since May last year, right? I mean, markets have just been in this range between 38 and 4,200, 4,200, 3,800. We've been in that range for a long time. But as earnings start to roll back in, as we see consumer weakening a little bit, then it's possible the markets do take that direction on the downside a little bit further because of the valuation. So once again, it's simple math, right? If you come down to the valuations again, if earnings do drop, let's say down to 210 or even down to $200, then all of a sudden you've got a market trading at almost 20 times earnings. If it comes down to, let's say, 195, then you've got a market trading at a little bit over 20 times earnings at the moment, which can be seen as a little bit more of an expensive market where valuations are not super undervalued, so to speak. So, just wanted to go over this. Let me know your thoughts down in the comment section below. This is a good chart to look at because earnings do eventually matter, right? That's what actually drives the market, in my opinion, is earnings. If earnings are strong, the markets are going to be doing good. If earnings are not so strong, because everything we talk about, right, from a macro perspective, interest rates, inflation, unemployment, economy, like everything all trickles down to the bottom line, which is earnings. And if earnings are strong, markets are strong. If earnings continue to get revised down and lower and get cut down, the markets are going to find it struggling, find it hard to actually rally. So hope you guys enjoyed this video, found it helpful. Let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. Happy investing. I'll see you all in the next video.